Most people think that if a wealthy investor wants a company, he buys the stock. But in the real world, when a business gets weak, the smarter move is often to buy something else first, the debt. Because when a company is healthy, the shares tell the story. But when a company gets stressed, the debt starts deciding the ending. Take David. He runs a manufacturing company outside Chicago. Industrial parts, about 60 employees, long-term customers, a warehouse full of inventory, a revolving line of credit from the bank, a term loan he took out when business was expanding. For years, it worked. Then, the pressure started. Orders slowed. Raw material costs jumped. One major customer stretched payments from 30 days to 75. Cash got tighter. Margins got thinner. The business still looked alive from the outside. The sign was still on the building. The machines were still running. The trucks were still leaving the lot. That is what makes these situations so deceptive. From the street, it still looks like David owns a company. From inside the capital structure, the company is becoming a countdown. And that is the first thing ordinary investors miss. They look at a struggling business and ask, is the stock cheap? Sophisticated investors ask a different question. Who controls the next move if this company gets weaker? Because ownership and control are not always the same thing. When business is good, equity feels like power. The owner hires, expands, negotiates, and makes the big calls. But when a company gets squeezed, power begins to migrate, away from the logo, away from the story, away from the founder sitting in the corner office, and toward the documents nobody cares about when times are easy. The loan agreement, the covenants, the collateral package, the maturity schedule, the rights attached to the debt. David thinks he has a business problem. Lower sales, temporary pressure, a rough year. What he actually has is something much more dangerous, a financing problem that is about to become a control problem. And those are not the same thing. Years earlier, David borrowed money to expand. New machines, more floor space, more inventory, more output. At the time, debt felt like fuel. Now, it feels like surveillance. The bank starts asking for more reporting, weekly cash updates, inventory values, accounts receivable aging, forecast revisions. Then comes the warning David was hoping not to hear. He is getting close to a covenant breach. That sounds technical, but the idea is simple. A covenant is a tripwire. It is a promise inside the loan documents that says the borrower must stay within certain boundaries. Maybe minimum liquidity, maybe leverage ratios, maybe restrictions on what assets can be moved, what new debt can be raised, or what cash can be paid out. If the company crosses those lines, creditors can gain new rights, including the ability to accelerate the debt and force a much harder negotiation on their own terms. That is the moment the emotional story stops mattering. Because the bank is no longer thinking like David. David is thinking, how do I save my business? The lender is thinking, how do I protect my position? That sounds like a small difference. It is not. It changes the entire game. And then, something happens that owners almost never see coming soon enough. The bank sells the loan, quietly. No headline, no dramatic takeover, no public announcement that control is shifting. Just paper, changing hands. David goes to sleep owing money to a commercial bank. He wakes up effectively negotiating with a distressed debt investor. And this new buyer did not purchase the loan to collect a little interest. He bought it for leverage. Here is why that matters. Imagine David owes $10 million under a troubled loan. If that loan is trading at 55 cents on the dollar, a distressed investor may be able to buy that position for $5.5 million. But once he owns the paper, he is not negotiating as someone who risked $5.5 million. He is negotiating as someone holding a $10 million claim, with legal rights tied to collateral, deadlines, defaults, and restructuring votes. That is the hidden asymmetry inside distressed debt. The price may be discounted. The influence is absolute. This is why wealthy investors buy the debt first, because debt sits closer to the machinery of control. If David needs an amendment, the debt holder can say yes, no, or yes on new terms. If David needs more time, the debt holder can charge for that time. If the company needs fresh financing, the existing creditor has a huge advantage. And if the business finally tips into bankruptcy, secured debt may hold the strongest seat at the table. That is not just theory. In a bankruptcy or restructuring, an investor using a loan-to-own strategy can push for a plan that converts debt into equity, or use secured debt to credit bid for the company's assets. In plain English, instead of showing up with fresh cash like a normal buyer, he can use the debt claim itself as a weapon to win outright ownership. Now, the story gets darker, because once David is under pressure, time stops being a business variable and becomes a debt variable. Every week that passes changes the balance of power. If he stabilizes the company, the distressed investor still wins because the loan rises in value. If he stumbles, the investor gains even more leverage. If he runs out of room, the investor may end up owning the company through the restructuring itself. That is the hidden logic most people never see. Buying the debt is often not separate from buying the company. It is the path into buying the company, just from a much stronger position. And Wall Street has played this game for years. Look at Caesars Entertainment. When its operating company entered Chapter 11, the fight was no longer just about running casinos. It became a battle with major creditor groups and distressed investors over who would bear losses, who would recover value, and how the company would be reorganized. Caesars itself announced an agreement with first lien note holders as part of a restructuring intended to cut roughly $10 billion of debt and slash annual interest expense. Harvard's case summary describes it as a battle between the company and large distressed investors over control, restructuring, and creditor value. It was a complete shift of power. That matters because it shows what distress really does. It moves the center of gravity. The public still sees the brand. The real game happens inside creditor negotiations. And if you want an even cleaner example of the endgame, look at Pierre Foods. Oaktree acquired Pierre Foods out of bankruptcy during the 2008 recession. Years later, after combining it into Advance Pierre and building it into a much larger platform, Tyson agreed to acquire Advance Pierre in a deal valued at about $4.2 billion. That is the power of entering through distress, reshaping the asset, and exiting later from a much stronger base. That is textbook execution. Back in Chicago, David is still walking the factory floor. He is still talking to customers, still trying to reassure suppliers, still trying to save the business he built. But the real action is no longer happening on the shop floor. It is happening in lender calls, legal drafts, revised cash models, amendment fees, collateral reviews, and restructuring proposals. That is the brutal lesson. A weak company is not just a company with bad numbers. It is a hierarchy being exposed. Who has collateral? Who has priority? Who can block a refinancing? Who can approve the extension? Who gets heard when the runway disappears? Equity owns the dream. Debt owns the deadline. And when a business gets weak, deadlines beat dreams. That is why sophisticated money loves situations that ordinary investors run from. Chaos strips away the marketing story and reveals the legal one. It forces everyone to ask the only question that matters under stress. Who has the strongest claim on the future? Sometimes that is the founder, sometimes it is management. But in many distressed situations, it is the person who owns the paper above the stock. The person who can force the negotiation, the person who can fund the next step, or refuse to. The person who can turn patience into fees, delay into leverage, and default into ownership. Once you see the system that way, elite behavior stops looking strange. Of course, distressed funds care about covenants. Of course, they care about maturity walls. Of course, they care about collateral packages, lien priority, and restructuring votes. They are not just studying value, they are studying position. Not just who owns the company today, but who gets to decide what the company becomes tomorrow. That is the deeper lesson here. Ordinary investors ask, who owns the company? Sophisticated investors ask, who controls the next move if the company gets weaker? Those are not the same question, and the gap between them is where a lot of wealth gets made. That is why the rich buy the debt before they buy the company. They are not chasing the headline. They are buying the pressure behind it. They know that when a business starts slipping, the story gets louder for the public, but the documents get more powerful for the people who know where to look. And once you understand that, you stop seeing distressed companies as just businesses with bad numbers. You start seeing them for what they really are, a hidden transfer of control already underway. Follow for more videos on how money really works.